Alright, let's jump into chapter 16. So you can start by downloading the chapter file in Canvas. So if you go into Canvas, go to Files, then Excel files for chapter videos, and then it will list off all of the blank files. And so we're doing chapter 16 here. So we got that pulled up. And so the first problem that we're going to work on is problem 16-2. And so what 16-2 is asking us is we have to classify these different costs either as a direct material cost, a direct labor cost, or factory overhead. And so all three of these costs are going to be what's considered product cost, which are all costs related to the manufacturing process that are going to go into inventory. And so we just have to separate them out. So they're all going into inventory, which will eventually become part of cost of goods sold. And so we need to designate each one of these activities, each one of these costs as direct material, direct labor, or factory overhead. And so the difference between the three, we have a direct material cost, and so that's going to be material that is significant and directly related to the product or cost object that we're working on. Direct labor is going to be the labor that's going to be directly related to that cost object. And factory overhead cost, which is going to be part of the manufacturing process related to the product, but not maybe directly related or not significant. And so let's go ahead and jump right in. So the first one is a plant manager salary for the Iowa City plant. And so a plant manager usually isn't directly, he isn't spending all his time on one single product or even one single product line usually. And so that's not going to be directly related to a product. And so that means it's factory overhead. We have maintenance supplies. And so maintenance supplies aren't directly related to a product. They go into a lot of different things. And so the chances are they're also not going to be significant either. At least we hope we don't have significant costs there. So that's going to be factory overhead as well. Salary for process engineers. And so process engineers usually aren't directly related to one product. They're over several different things. And so they're going to be factory overhead. Wages paid to packing department employees in the Bear River City, Utah paper products plant. And so this one is kind of tough because they're not actually telling us what our cost object is. And so in this one we just kind of have to assume that, hey, this is employees that are just in the packing department, and the packing department just does the products that we're looking at. And so I think what they're looking for on this one is direct labor cost. The next one is scents and fragrances used in making soaps and detergents. And so that's something that's going to go directly into a product. And so that's going to be a direct material cost. Then we have wages of production line employees at the soap and detergent plant. And so usually right when you have somebody that's a production line employees that are directly involved in that product, and so they are going to be a direct labor cost. Depreciation on assembly line. And so depreciation is almost always going to be an overhead cost. It's not something that directly goes into to a product. It's usually something that's it's allocated. And so factory overhead is allocated, and so that's going to be a factory overhead cost. Packing materials. And so packing materials, that's usually a product that's going to be part of your overall product and presentation. And so that is going to be a direct material cost. Resins for body wash products, that's something that goes into the product directly, so that's going to be a direct material cost. And then again, we have depreciation on manufacturing equipment, and depreciation is almost always going to be a plant manufacturing or factory overhead costs. So pretty simple one. Nice warm up to kind of get started here. This first chapter 16, it's really a lot of terminology and just getting used to different words and terms and what they mean. Not the most exciting stuff, but it's really imperative that we understand what these terms are that we're going to be using throughout the chapter or throughout the class. So let's go over here and jump over to the next one. And so this is going to be example 16-4. And so what 16-4 is now they want us to identify and classify objects in cost as either a product cost or a period cost. And so the difference there is a product cost is something that's a part of the manufacturing process, manufacturing cost. And so these product costs, that's going to be our direct labor, our direct materials, factory overhead, that type of thing. Then we have period cost. And so period cost, instead of going into inventory, they're going to be expensed as incurred. So these are going to be things related to the cost of selling an item, not the cost of making it, but the cost of selling it, or it can even be administrative cost. So if we go down and take a look at these, so research and development. Okay, so GAAP tells us, if you remember back to your financial accounting class, R&D costs are never capitalized, and so they are going to be a period cost. Depreciation on sewing machines. Okay, like in the problem we had before, we had a couple depreciation examples. And so depreciation related to the machines and the manufacturing process, that's going to go to factory overhead, which is going to be a product cost. Fabric used during production, and so that's something that goes into the product. That's going to be a product cost. Depreciation on office equipment, that's administrative. That's going to be expensed during the period. That's a period cost. Advertising is related to selling it, not making it. And so that's going to be a period cost. Repairs and maintenance on the cost of the sewing machines. So these are the machines that are involved in the manufacturing process. So that's going to be a product cost. Then we have salary of production quality control supervisor. And so this item here, this is somebody who's as part of production. And so if he's part of the production, he's part of the manufacturing, that is going to be a product cost. Then we have utilities for the office building. So that's the office, that's administrative, that's a period cost. Sales commissions, anything related to selling it, is going to be a period cost. Salaries of distribution center personnel, and so the distribution center, that's kind of that's like the very end of the manufacturing process. And so that is going to be a product cost. And then K, so we have wages of sewing machine operators. That's part of the manufacturing process. That's a product cost. Factory janitorial supplies. And so this is going to be a factory related, and so that's actually going to get lumped up into the product cost. The CFO's salary. So the CFO's salary, he's not related part of the manufacturing process, so he's going to be a period cost. Travel cost of media relations employees. They're not part of the manufacturing process, so that's a period cost. Factory supervisor salaries. So part of the factory, part of the manufacturing process. That is a product cost. Oil used to lubricate the machines. That is going to be a product cost, going to be part of our overhead. And then we have property taxes on factory building and equipment. So this is part of the factory, which is part of the manufacturing process. That is going to get lumped into our overhead, which is a product cost. So not too bad stuff at all. So let's go ahead and here and jump into our next problem, which is problem 16-9. Hey, in this one we actually get to play with numbers a little bit. I'm just gonna bring this up so we can see a little bit more. Hopefully that's not too small for you guys. And so in problem 16-9, so it says the following events took place for Wave Video Manufacturing during 2016. The first month of its operations as a producer of digital video monitors. Okay, and so it looks like it's asking us to do two things. It's to prepare an income statement for the period and also determine the inventory balances at the end of the first month of operations. And so it looks like I left some of our numbers in here, so that makes it a lot easier. So let's just walk through these line by line, and what we'll do is we're actually going to do number 1 and number 2 at the same time. And so we purchased 133,000 of materials. And so when we purchase materials, if we go down here, that's going to go into our materials inventory right here. So the next one is we used 94,000 of direct materials. So now when we use materials, we're going to take it out of our materials inventory, and then we're going to bring it over to our work in process inventory. So out of materials into work in process. So now we incur 211,000 of factory overhead cost. And so when we incur factory overhead, that's going to go into our work in process. And so that's going to increase our work in process inventory right here. And then we transferred 425,000 of work in process to finished goods. So we take that 425 out of work in process and we're going to move it into finished goods. We sold goods with a cost of 365,000. And so when we sell goods, we take it out of our finished goods right here. And so this is the first transaction. Before, all of these have not affected our income statement. These have just been inventory transactions. But right here, we sold goods with a cost of. So this is our cost of goods sold right here. And so what we want to do is it came out of finished goods. And so that's going to be a credit entry, and our debit entry right here is going to be 365,000. And we earned revenues of 652,000. So plug in our 652,000 as revenue. So that's going to give us a gross profit of 287,000. The next one is we incurred selling cost of 86,000. And so our selling costs are down here. So we got 86,520. And so selling expenses are not part of inventory, so they're not down here. They go directly to our income statement. Then we have administrative expenses of 71,250. So it gives us a net income for the period of 129,230. And then our ending inventory for the month for materials, work in process, and finished goods are right here. So not too bad. So the key to this problem is just identifying, hey, is this part of our inventory? Is this part of our income statement? So not too bad at all. So let's work over to the next problem. And so the next problem is 16-13. And so here we have, it's talking about cost of goods manufactured for a manufacturing company. And so we have a lot of similar terms in managerial accounting. So we have cost of goods manufactured, which is, but don't get it confused with cost of goods sold. So as we go through a period, a month or a year, we're going to go through and we're going to be making goods, put them in finished inventory, and then we're going to sell the goods. And so when we sell the goods, that's when we have a cost of goods sold. But when we're making it, we might make some, sell some, but not sell part of it either. And so the cost of goods manufactured is the cost of everything that we made during the year. And so both are two different numbers, but still important. So let's go ahead and see. It says determine the cost of goods manufactured for the month. Okay, so we have cost of direct materials related to production. So now the general process, we can work this around and kind of move this around and have it look different ways. But this is, so we're going to start with our beginning balance. We're going to add our cost, subtract our manufacturing cost, give us an ending balance of work in process. But what we're looking for here, right here, is the manufacturing cost. So for the information that we have, it gives us the cost of direct materials for the period. And so that's going to be $390,000. It gives us our direct labor for the period, which is $336,000. And down here at the bottom, it gives us our factory overhead of $234,000. So we've added $960 to the process. And so then it tells us what our beginning inventory is. Our beginning inventory in work in process is $162,000. And it also gives us our ending inventory of $170,400. And so what this is doing, if we started with 162, we added 960. So that is going to give us a total of $1,122,000. And that means that we had to manufacture $951,000 to leave us with an ending balance of $170,400. All right, so let's jump to our last problem. Problem 16-5A. And so, okay, this problem, so we have a bunch of information from NewQuest Corporation, and then it's asking us to prepare a statement of cost of goods manufactured. It gives us this little check figure here to see if we're on the right track. That's kind of nice. And then prepare an income statement for the year. So let's just go ahead and start working through this. And so for the statement of goods manufactured, we're going to always start with our beginning work in process. And so this tells us that it is $631,800. So that's going to be right here, our beginning balance. Then we're going to add in our direct material cost. And so it tells us that our materials beginning inventory is $351,000. Okay, that's going to be right here. And then what we purchased during the year. And so down here we have materials purchased. So that's going to be $659,800. So that means the cost of materials available to use is our beginning inventory plus our purchases. That gives us a little over $1 million. Let's make this a little bigger. But then we have to subtract out our ending balance, our ending materials balance of 436,000 right here, to give us the actual cost of materials that we used in production. So we took into consideration our beginning inventory, our ending inventory, and our purchases to figure out what went out. So out of all the materials, 574,000 actually left and actually went into production. So now we have to add in our direct labor, which is 670,800. So that's going to be right here. And then now we have to take into consideration our factory overhead. So we have our indirect labor of 78,750. That's right here. We have our depreciation of 56,160. We've got heat, light, power for the factory of 22,460. We've got property taxes, 18,500. We have our rent expense for the factory, 32,000. We got supplies at 15,400, and then it gives us miscellaneous factory cost of 9,500. So the total overhead that was incurred during the period, 232,770. So the manufacturing cost incurred during the year, so that's going to be, we incurred direct material cost, we incurred direct labor cost, we incurred overhead. It's 2.1 million. And so we have our beginning, we have what was added, then we have to subtract out what our ending inventory was to figure out what was used. And so our ending balance is going to be 592,570. Whoops, that's wrong number. 592,800. So that's going to be our ending balance right here. So that means during the year, combining materials, labor, and overhead, the cost to manufacture everything that we made, not everything that we sold, but everything that we made, was 1,516,570. And so it looks like that matches our check figure over here. So cool, good deal. So looks like we're on the right track. So now what it's asking us to do is put together an income statement. And so when we used this information over here, basically everything that related to the factory, that went ahead and went into our cost of goods manufactured. And so now stuff that's related to the office and not related to the factory, that's going to go into our income statement. So if we just start at the top, we have our sales, and so sales are 3 million. Oops. 3,010,000. And so now we have to figure out a cost of goods sold. So we know what our cost of goods manufactured was, because this comes over from our cost of goods manufacturing sheet. And so first we need to figure out, hey, okay, what did we start our finished goods inventory with? And so we started our finished goods inventory with 608,400. So that's right here. So we started with 608, we added 1.5. So total available to sell for that year was 2.1, but we have to subtract out what we ended with to figure out what was actually sold. And so our ending balance is $576,000, which gives us cost of goods sold of $1.548970. So if we take our sales, subtract our cost of goods sold, we get our gross profit, which is 1.461. So that's the hard part. Now we just got to plug in our operating cost. And so we had office salaries of $185,000. We had depreciation related to the office of $42,120. We had property taxes related to the office at $32,400. Then we had advertising expenses of $296,400. Whoops, extra zero in there. And then we have sales salary expense of $420,000, which gives us a net income of $485,110, and we are done. So not too bad. The key here really is just identifying, hey, what's a office cost, what's a factory cost, to make sure we get it either into inventory through the cost of goods manufactured, or go straight to the income statement.